Welcome everybody. This is Drew from my channel Sales Ronin, and this video is specifically on your broker is taking money from you. I think I put your stockbroker stealing from you, but in actuality, they're taking from you what could actually be yours. And again, my name is Drew. Sales Ronin's this channel. I've been in the markets again for, you'll hear me say this from time to time again. I've been in the markets since 2000. Myself personally have been professionally trained on stocks, options, futures, and currencies. I worked for the top S&P trader and the top options trader at the Chicago Board Options Exchange for the better part of a decade. And what I'm teaching you here is not only what I've learned, but what I actually use. And again, I use the channel Sales Ronin because I'm not beholden to any company or any product. I sell what works. And a lot of these videos are on what I actually do, what I actually use in the markets to profit. Now, a lot of people, I'm going to show you here, and you can see that this page here, all the top stockbrokers out there. You got Vanguard, TD Ameritrade, Fidelity, Interactive Brokers, Charles Schwab, Robinhood, and there's a ton more. But a lot of people don't know this about stockbrokers and how they are taking money from you. That could be yours. That could be yours. They're not stealing. I know I put that in the actual, header of this video, but it's actually they're taking money that could be yours, and I'll show you why. So everyone should know how a bank works. If you don't, okay, I'll show you now. So you got the bank. That's a bad drawing. Let me draw a better drawing here. A bank, what do you do with the bank, right? You deposit money, okay? So here you are, take your hard-earned pay, and I know this is a terrible stick drawing, and you deposit in the bank, okay? Now, the bank actually, with those deposits, gets a multiplier. Okay, they actually get credit. They can borrow. You'll hear people say 100 times, several hundred times. The number is dependent on the size of the bank, the number of their deposits, and also how creditworthy the bank is. They're just like us, right? If they got good credit, they're going to get a high multiple. But let's just say they get 10 times the deposit. Okay, so if you put in, $1,000, they're going to get $10,000 of borrowing power. And what's crazy is they're going to pay almost no interest. They pay the Fed funds rate. They pay the rate that the Federal Reserve has set for between them and the banks, which is a fraction. We're talking now it's like sub 1% or just over 1%. It changes daily because it's on a base rate that's also traded, but for simple purposes, the interest rate's 100 times less than what you would pay on your credit card, your mortgage payment, your your vehicle payment, whatever you're paying. It's a fraction. So they're getting times 10 that, and that means that they have the ability to really lend out that money to tons, and these are heads of people, tons and tons of people, because they've got more money that they're borrowing less. They're doing arbitrage, right? They're lending out money. They have access to way more money than you do, and they really take advantage of your deposits. Now, here they're really not taking advantage of you because why? Because you don't have their facilities, their infrastructure. And they are going to pay you a very small interest on deposits, right? So there is a quid pro quo, there is a give and take there, and this has been what people know and have known for hundreds and hundreds of years, okay? And that's the traditional model of lending, banking, and lending, right? And so that's how the bank makes their money, right? That you deposit, they get a ton of leverage from the Federal Reserve, and then they are able to borrow that tons of money at a fraction of what they can lend it out at, right? Here's a car payment that's at 9%. Here's a mortgage payment at 4%. Here's a credit card at 22%, and the list goes on, and they're paying less than 1% interest on that money. So you can do the math on how much they could make, right? Well, here comes your broker. And this one will probably shock 99% of the people watching this video. You're a broker. What do? Well, you don't put money in. I mean, you can put money in, right? But really,
I couldn't hear what you said.
Really, you're buying stock, right? So here's you. You're going to go to your broker, and you're going to buy stock. And I'm going to put a piece of paper with an S on it. Now, that stock has value, right? Let's say it's $100 a share. It's in your name, but it sits in the care of that broker. Now, this is what people don't realize. This also gives the broker access to multiples of money. It has a cash equivalent value that they leverage. Okay, so they are also able to lend out at a much, much higher rate because they have deposits in their institution, in their brokerage, in stock face value that they can convert to cash value and borrow against it at extremely aggressive rates, way better rates than you and I could ever get, right? So that's one thing that you probably don't know. I would say 99% of the people don't know, or at least a high percentage. Let's say over 80%, okay? So the broker is getting 10 times the value on deposits based on stock in their brokerage, okay? And they do give you some value. I shouldn't say that you're taking advantage too much because they give you what's called margin, right? So for most people, if they put in a certain amount of money, let's say 10 grand in stock, right? Well, if it's cash, they'll give you margin. If it's in stock itself, they don't give you margin. But you could buy usually 4 times. Most brokerages will give you 4 times the cash to borrow to go into stock that you want, and then they hold those stocks. But then they get a multiple of that in value, extremely much higher than you could ever get on your own at disgustingly low rates. Okay. Now, here's the thing that you don't understand. They can lend out just like a bank can lend out your cash that you deposit. A broker can lend out your stock. So that stock that you bought, they can actually lend it out. Now, what would someone do when they borrow your stock? Well, I'm not going to go into a detailed conversation or a training on it. You can look it up yourself, but it's a very popular term you might hear in the markets. But someone borrowing your stock that you bought with your brokerage, they can short your stock, okay? Short your stock and make money on it if that stock goes down. If that stock goes down. Now, some people ask, hey, listen, how does that work? Again, you can look up how stocks are shorted. There's long descriptions. It's a very sophisticated strategy. You need a lot of money to do it. And your broker has to be pretty big because they have to own a lot of those shares, not only from you, but from lots of people to be able to short a stock. It can't be a no-name stock, and the brokers can't have like one share of it. They have to have thousands and thousands of shares. But why is this important for you to know? Well, because in shorting a stock, okay, the bank is saying, hey, lend you out the stock. You're going to short it. If it goes down, I owe you money. If it goes up, you owe me money, the person that borrowed the stock, right? Not you. You bought the stock, and you're getting your stock used without you knowing it, and people are making money on your stock without you knowing it. Now, again, how does the broker make money if it goes down? Well, they have to lend out the stock, and then they have to pay the difference to the person shorting the stock. But remember, they have multiple value of the value of that stock, so they can sell calls against the stock that you own. So they're able to make money on your stock, whether it goes up or down. is really what I'm just trying to communicate. But they can't if you're doing that strategy. Yes, you can sell options on your stock and make the income that your broker makes on your stock. And when you do that, they can't lend out your stock. They can't lend it out to people to short it. They can't write options on it themselves. You're basically doing what the broker can do. And since you're doing it, they can't do that on your specific stock. So I have training on how options work. Just look it up in my videos in Sales Ronin on how options work. And then separately, there's one on selling options, right? Selling calls specifically. But that's the value proposition that I would say 99% of people don't know, that when you go and buy a stock and the broker holds it in your name, you're actually authorizing that broker to lend out your stock and write calls, meaning make an income from that stock just sitting there, which you can do. And I teach you how to do that. I actually have a video on selling calls. Just look it up in Sales Ronin. I also have that video on how options work as a basic. But if you want to know how shorting stocks work, I would look that up because that's a very complex. I mean, that would take me a good, I would say, a good couple hours of dissecting a lot of information on how brokerages work, how the shorting mechanism works in the brokerage, at a retail trader level, at an institutional trader level. But the average person cannot short a stock. You need a lot of money to do so. And then the stock you pick to short, your broker has to have a lot of those shares that they can actually do the transaction with. They can't do it if they only have, a handful or a very small amount, because it's a highly leveraged position for the bank. Because if it does go down, they owe the person that's shorting the stock money. So they have to take that multiple, that high value average of stocks they're holding, to do a leverage or a call strategy or an offsetting strategy where they're actually making income from that stock. But I'm going to teach you, if you watch my video on selling calls or selling options, specifically calls, just look up that video. But again, you're probably freaked out. If you're not, you should be, because your brokerage, number one, they're using your stock with your consent, by the way. When you sign that long disclosure document that you don't read and you say, okay, I agree, you're doing two things, by the way. Number one, you're saying, hey, there's no insurance on my deposits. So you can lose 100% of your holdings if something went bad with your brokerage. Okay? Now there's ways to protect yourself, and I teach that on covering your positions. You can actually insure your positions against downside, but they're not insuring your deposits. Your stock, they're not insuring cash you have in there. It is not FDIC insured like normal banks are. 99.999% of all brokerages out there, your deposits and your holdings, your stock, everything you have in there is not insured. And then number two is that you're allowing that broker to use your stock and make money on it by loaning it out for shorts and also writing calls in those stocks and actually taking income that you could make. That money could be yours. So I hope you enjoyed this video. By the way, leave comments, ask questions in the comments. I try to read them and get back to people, or any topic you want to cover. I have a lot of experience. If I don't know it, I can find it out, or I have someone that I know that can find it out. Thank you for your time. I hope this was very enlightening for you.